This video will follow up on the previous one and is based on the accounting cycle that you just learned about. And in this course, we're starting with the end in mind. So at the end of the accounting cycle, whether it's a month or 6 months or a year, the company prepares financial statements. And we start with that because it helps to have the goal in mind so we know where we're going. So this video will talk about one of the two financial statements that we will be stressing. This is called the balance sheet. You've done some work with this already, and the one on the screen that you're looking at may look familiar. This is the one you dealt with yesterday. At least it's similar to that. So we want to first of all take a look at the parts. This, as I mentioned earlier, is a very important concept. It's very important that you're clear on the elements in this balance sheet because we'll be working with these different things an awful lot in this semester course. So at the top of the balance sheet, you see the name of the company and the date. And it is the balance sheet, which means it has to balance both sides of it. It has two sides. Both sides have to equal, and we see that it does at the bottom. Let's look at the parts. On the left side, you have a list of assets. These are things that the things that the company owns. They are things of value that the company owns. And there's a description of each one. There's cash, obviously value there. This company breaks it down to cash in the cash register and cash in a savings account. Office building, office furniture, computers, truck, and some donations given by the wonderful students. Anyway, these are all things that are of value, and the total of those assets, as you see at the bottom, is $173,050. And again, if you are not used to Excel, please remember that up here in this line way up at the top, you can see the formula. And an easy way to do this formula is to go way up at the very top. You can just barely see it. There's something called auto sum, and that's a shortcut if you're just adding a column of numbers. At any rate, left side will always show total assets, 173,050. The right side will show a couple things. It will show liabilities. First of all, liabilities are things that we owe. These are debts that we have. We owe this money. And there's a description. And there are some loans. We have a loan for office furniture, so we owe $1,000. There's a mortgage. A mortgage is simply a long-term loan, typically on real estate, buildings and property. So there's a mortgage on the company building of $55,500. There's a loan in this case for machinery and a loan for computers. So this company owes all that money. And the total of the liabilities is $60,850, and again, simply a total of those numbers. Now, owner's equity on the right side also. This is the value of the business. We will assume that this is a one-person owner, so he or she owns the business, and this is the equity of the business. This is the value to the owner. In a large corporation, the owners may be the stockholders. We'll talk more about that much later, particularly in the second semester in accounting too. But in a corporation, people own stock. You might ask your parents, maybe they own some shares of stock. If you own a stock in a corporation, you are literally and really an owner of that corporation. You may be a small owner, but you are an owner. So that's sometimes called capital and sometimes called stockholders' equity. So we're making it very simple to begin with. This is a single owner business, and so the owner's equity in this case is $112,200. You need to know how that number is arrived at. Very simply, you take total assets, you subtract from it total liabilities, and that should give you owner's equity. And again, up here in this line at the very top, you see the formula. And the formula is based on cells. 173,050 is cell C. You can't quite see it there, but C7. And you subtract liabilities, you get 112,200. The last thing on the right side of the balance sheet is simply adding these two numbers. Total liability plus owner's equity equals $173,050. So it does balance. This is based on the accounting equation that you should be familiar with by now. So this is how a balance sheet should look. When you set up a balance sheet, I want it to look like this. Assets on the left, liabilities and owner's equity on the right. You add up those two and you have a total that should equal total assets. One more thing that you should know by now. This statement gives a picture of a business on a specific date. This happens to be September 30th, 2019. The next day, it may change because maybe we spent some money. Maybe we paid part of the loan. So there's a number of things that can happen on a daily basis. But sometimes it's important to look at what we call a snapshot of the business. So on this date, at the end of this accounting period, which may be a month long, this is the value of this particular business, $112,200. Next month it may change. So let's go a little bit further with this, with a couple new things. Down at the bottom, you see tabs. If you're familiar at all with Excel, you know what that looks like. You can get different pages on the same spreadsheet. So we are on this page called Example 1. Now let's go click on this tab, and now we are in Example 2. This is the same exact balance sheet except for one thing. I have added something called accounts receivable of $8,000. And we'll talk a lot about accounts receivable. What that means is that the Altenburger company here sells something and people bought some things on account. And when customers buy things and they charge it, this to a business is called accounts receivable. This is an asset. And accounts receivable, which means somebody owes us money. Now, in the real world, we know that not everybody pays their debts, and sometimes we have something called bad debts, and we have to deal with customers that just simply don't pay us. So we're not ready for that at all. At this point, we're going to make it simple, and we'll deal with bad debts a little later. At this point, we will assume that all of these people will pay us what they owe us, and they owe us a total of $8,000. So when we put this in, this is an asset. But look what it does. Obviously, it should increase total assets. In example 1, total assets was $173,050. I added $8,000, so it went up. On the right side, we will assume liabilities doesn't change. We don't owe any more money. It stays the same as it was in the first example. But look what happens with owner's equity. Now that went up. When you subtract liabilities from assets, you get $120,200, and that means the owner has a greater value because people owe us money. And when you add these two numbers, liabilities and owner's equity, you get $181,050, which balances. And incidentally, the proper way to show this balance at the end of a balance sheet is putting double lines underneath. That's why I've done that. Doesn't have to be, but that's standard practice. Again, generally accepted accounting principles. So the double lines. So that's one example. Now let's go to the third example I want to show you. Again, the same company, the same balance sheet, the same date, and I've kept accounts. I've kept accounts receivable here of the $8,000, but I've added on the right side something new. Now we have something called accounts payable, and you might be able to figure that out pretty quickly. Accounts payable means something that we owe. It is a liability, so it's listed with the liabilities. It's something that we owe. So sometimes we charge something, and then we have to pay it, obviously. So we owe $6,000. Now, we also owe for all of this stuff, all these loans and the mortgage. The difference between these kinds of things and accounts payable usually is that accounts payable are short-term debts. Typically, we buy supplies or merchandise or pencils or paper or something on a short-term basis and we charge it. Typically, an accounts payable is something that we owe that needs to be paid within 30 days. That's usually the difference. These are longer term. Loans and mortgages, maybe a year, maybe 3 years. A mortgage may be up to 30 years that we have to pay off this loan for the company building. So that's the difference. Accounts payable typically are short-term loans, or excuse me, short-term debts that we owe. So we don't really call them loans, but they are liabilities. Again, let's look what happened here. Now total liabilities went up by $6,000. We added $6,000 to it, and if everything else stays the same, if we didn't change this on the total asset side, but we did change total liabilities, that means now, look what happened. We subtract total liabilities from total assets, and now owner's equity is down to $114,200. Add up these two, and the total is the same on both sides. Whoops, it should be. It's not. It should be because I didn't change this down here from the previous example. What I should have, and let me show you how to do this very quickly. Take this out, and if we go way up to the top, we put the auto sum, click on that, and if I put my cursor over the numbers I want to add, these two, and I hit the return, there's my total. So now this shows in this cell, this is the formula, which I just did based on the, excuse me. Kind of messed that up. Sorry about that. So it now has the formula that shows the addition of these two. So now our balance sheet does balance. So now we're back to where we should be. One more thing I want to mention here before I finish this little video is another asset that we'll learn about later in the course called inventory. So if this company sells something, if it's a grocery store, a hardware store, for example, it will sell something. And we need to have things on the shelf that we will sell to customers. And that's called, that's called inventory. And that would be an asset. It would be listed over here. And we will talk about that later, not to worry about it right now, but that's a very important concept that we will spend some time with. Inventory could be purchased for cash. We'll buy inventory and pay cash for it. Often, though, when companies buy inventory, they charge it, which means the inventory would be listed as an asset and our accounts payable would go up based on how much inventory we purchased. So that will come later. Right now, I want you to be able to handle the basic parts of the balance sheet, the assets, the liabilities, computing owner's equity, and making sure things balance at the end. At this point, I want you to go back to your course page, and there will be an assignment for you.